Welcome to the Weekly Rate Update. I'm Craig Fuller here with my co-host, as always, John Paul Hampstead. JP, you were at Armstrong and Associates, which is a big conference. A lot of it focused on the 3PL sector, and specifically M&A is really the hot focus. So you get a lot of the core executives, C-level executives of the largest and biggest players in the market. What did you hear them talking about?
There were two things that I heard a lot, actually, that I thought were really telling. One is that investment bankers there were complaining that 3PLs who wanted to sell themselves were quoting 2018 revenue numbers.
Oh, wow.
Right?
So they weren't even talking about 2019.
Yeah, and then...
And this is October.
Yeah.
Like, you can get away with that in January, February, March. You can't get away with that,
Like, not even trailing 12 months, just 2018.
Well, like, the first 3 months you can get away with that, but like, by the time you hit April, you're really sort of baked on your 2019 numbers of that year. Like, so that, and then secondly, some of the bigger players, they're asking about, sort of the forward-looking, outlook, right? And they were all saying that they didn't want to talk about Q4 or Q3, frankly. They basically said, we think that the market will turn up maybe Q2 2020. So everybody's consistent about the fact that this year is going to be pretty soft.
Yeah,
and especially finish the year soft?
Especially on a top line revenue perspective, not necessarily like
margin
volumes, not necessarily margin, but just net revenue per load in dollars is pretty far off 2018.
But so when net revenue is all about margin, you're saying margin compression?
It's margin and the
gross revenue
and the base.
So
right.
Okay.
So like, if you can have a wider margin, but if it's a cheaper load, the net revenue dollars per load is going to be lower.
So the margin percent is expanded because of the delta between spot and contract.
Right.
But the actual gross dollars billed is quite small. Now part of it is, fuel did have a big run up last year, so fuel expands those rates, but also just the overall rate environment is much softer this year. And demand is, people are fighting. I wanted to ask you, is there any discussion about the impact of the digital players? I'm hearing from some of the larger incumbent folks that are not in the digital world that they're starting to see contract rate pressure on bids where the new age players are showing up in those bids and taking share.
Oh, yeah.
So is that being discussed?
So there was a CEO of a large managed transportation company who spoke directly about this, talking about some of the new digital entrants, and he said Uber Freight wins bids. They're winning not by $50, not by $20, they're winning by $200, $300. And he was like, you can tell that he was almost like, that's excessive. He was like, their pricing algorithms need work, obviously, still. And so,
but is that pricing algorithms or is it an intentional desire to gain share? Because I actually think there's an intentional desire to gain share.
But why win by $300 if you can win by $75?
If you have unlimited, conceptually, if you look at Uber as a public traded company, multitude, and in fact, if you took all of the public trucking entities, whether we're talking C.H. Robinson, Echo, J.B. Hunt, maybe Schneider, I think conceptually all of those combined would actually be, at least truckload, would be less than Uber's market cap as a single entity. Now, granted, a lot of that's based on their personal transportation, on their Eats product.
Right.
But still, they have a massive war chest with effectively free capital.
Yeah, there was a lot of talk about it. I think that people were skeptical of like how revolutionary the technology is. They tend to talk about it in terms of like incremental improvements over things that the most sophisticated players are already doing, but there was concern about pricing.
I don't think, and I have a lot of respect for Bill Drygart and Lior and the work of Uber Freight. I just think they're smart. They have the ability to attract a really smart team. I've never looked at Uber Freight as being, from a technology basis, being overly revolutionary. Like, they probably conceptually have better data scientists, they probably have better statisticians, they probably build better UI than 99% of the market does. But my view of it is they have something that no one in transportation can operate in, is this almost ability to go buy share. And I don't think that's...
They have that. The other big difference between Uber Freight and the ride-sharing business is that their huge advantage in ride-sharing was their ability to create capacity, to get people to operate essentially as taxi drivers who had never done that before. They don't have that same advantage to make a market with truck drivers.
No, I mean, look, conceptually it's a commodity. Conceptually, whether it's priced on a per spot basis or priced on an annual basis, it's, regardless of what anybody says, whether trucking and freight's a commodity, at the end of the day, pricing drives almost all decisions. Now, service plays into it after you're in the pricing guide. Like, service matters once everything else is created equal. Like, if you're competitive on price and you're in a band, because the market's so fragmented that as long as people can compete on price and get into a band, there may be a couple pennies off, and service does matter at the margins. It doesn't matter in the aggregate. Like, what a shipper looks at is says, I'm going to pick my least cost routing, my favorites. Maybe the guys that are so cheap that I can't depend on are not going to qualify, they don't have my technological requirements or my insurance requirements or my tracking requirements, or I can't trust the drivers that they're hiring. But once you sort of take those factors out, the qualification, you have a qualification category.
Yeah, and that's what we heard. Is
then price,
90%,
service is second.
90% of the decision is price.
So it's a commodity at the end of the day. And the thing is, if Uber Freight and anyone for that matter can go in and aggressively buy share it doesn't matter about capacity creation, they're effectively buying share, and as long as the public markets allow them to do that, then that is a very hard thing to compete against.
Yeah, no.
And it's not just Uber Freight, it's the fact that they're in the background of the bid that is going to create pressure on everyone to think about the fact that I have this player who's not operating under the way everybody else does in the market. They're not looking at maximizing their unit economics or margins. They're looking at gaining market share.
Right.
And you only need one that's big enough in the market to do that, to bring everybody to start chasing that rate down. And that just creates this market psychology where people start going after it.
And I think that the large capacity providers have always had to do this to get the business of big shippers. If you want to be Niagara Water Carrier of the Year, if you want to be Anheuser-Busch Carrier of the Year, you've got to be quite aggressive.
I mean, look, it's always funny looking at these Carrier of the Year awards, Quest for Quality awards that one of the publications do, because like the running joke is if you win a Carrier of the Year award, it's because you're the cheapest, and
you'll do anything to
win the business. Yeah. And so I think that's fair. What I'm hearing is the larger asset guys are going into are trying to shift as much capacity into dedicated, where it's almost like an annuity, where it's not managed transportation the way that a Transplace would do it,
right.
but more of I'm going to give a uniform driver. It's going to be there every day. I'm going to handle projects that need more consistency of flow.
It's like quasi-private fleet. Almost.
And spot, I'm going to leave that out for everybody else. Because effectively spot is your day-to-day commodity, and then contract is your annual bid cycle.
Right. And if you're dedicated, you can do more interesting things for customers that actually do have higher service requirements.
Yeah.
You can get into really high touch stuff like automotive. That's on like a lot of the tier 1 providers, suppliers to automotive. Their schedules are like on a 14-minute timeline. And so there are things like that if you dedicate assets, maybe you can get some more favorable pricing. Another interesting thing I heard with regard to rates was Doug Wagner actually said the difference between spot and contract is oversimplified. He's like, Wall Street fixates on it and always asks like, what's your mix? But he was like, in reality, contract can be renegotiated as often as every 6 months. And he said, the other thing he said, which is interesting, was that a lot of our spot business is actually relationship freight.
Yeah.
And we have reps that like certain carriers or have relationships with certain shippers, and they're getting the freight as spot. but there's all these tacit understandings.
And
it's actually more regular than it seems.
I absolutely hate, and I agree completely with Doug. I've always hated the term spot contract. Spot's easy to understand because it's all spot, right?
Right.
But the vast majority of decisions are actually made at the point of transaction. And exception to dedicated, which is in many ways an annuity. I mean, you could conceptually raise, it's fixed.
It's almost like a separate business.
It is a separate business, and the transactional business that's either contract, there's nothing binding about that. In fact, I hate the word contract, as we've talked about. It's committed. The word paper rates are committed is really the more proper word, but the word contract, Wall Street does fixate on it. I think it's a function of the truckload industry, the larger players, trying to distance themselves from the ebbs and flows of the spot market, and say, hey, there's this other market over here that we are not hugely exposed to, that those broader trends
it's volatile, but our revenues
is more consistent. And I think that's, I think it's fine in terms of if you're trying to describe it. But if you look at the stock prices, they all follow the spot market. You can actually take one of the companies that talks about having the least exposure, Knight Swift, talks about the fact they have 5 or 6% exposure in spot. But you take their spot price or their stock price and correlate it with the DAT spot, boom. It almost looks like that's how people trade.
Their revenues might not be correlated to spot market, but their operating ratios are.
Their operating ratios are and effectively spot is the reflection of the market. And that's why trucking stocks have sold off aggressively in the last 12 months, because everybody looked at the spot rates and said, these spot rates are not going to last. They peaked. And if you remember last year, everybody was searching for when the peak was. And there was, is this the peak? Is this the peak? And we saw it in June, and the market has not recovered. Neither has the stock market.
Interesting.
Trucking stock market, I should say.
As far as rates go, if you look at the forward curve from 30 days ago compared to the current forward curve, so in the trucking freight futures market, what they expect the rates to be, they're still expecting a peak in November of about $1.50 a mile on a national average basis.
What are we at right now?
141.
So we're talking about a 9-cent increase for peak.
Yeah.
That's a pretty muted peak.
Yeah, and that hasn't changed that much. What has changed recently is the volume picture. So we were running about 5% growth year over year. That's deteriorated to about 1.5% growth year over year.
Yeah, it's interesting. I think, so I was bullish on Q3 going into the summer. Even a month ago, I was pretty bullish. A couple weeks ago, I actually was. I'm not anymore. I've changed my view, and I don't think it's a fact of the freight market. I think the economy.
Yeah.
I think the broader economy, the industrial economy, is starting to see significant deterioration. So we saw some signs of deterioration. Freight sort of had this ebb and flow where it looked like had found a bottom or come back up. More of a, if you'd asked me a couple of months ago or a month ago, I would have said it's probably a V-shaped recovery.
Right.
I almost think it's more, we're going to have basically another dip as the economy sort of cycles. And that's going to have a tremendous impact on the capacity map. It's going to churn through a lot of capacity.
Yeah.
And it's, people are like, well, we've lost all these carriers. True, but there's nobody that's able to prove to me, and our data shows otherwise, that there are carriers still adding drivers.
Yeah.
I mean, even the trucking used truck market rates have held up, which suggests capacity is being added. So explain to me.
And if you go on Facebook, you go on LinkedIn, every time there's a shutdown,
everybody,
any driver who wants a job.
Everybody. So the drivers are in many ways fungible assets in the market. They're, one driver can leave a carrier shut down and go the next day and get a job at another carrier.
Yep.
And so I look at that and I'm saying that we're losing operating authorities, but we're not losing capacity.
Yeah.
And I think you have to separate those two, because if you don't, you're not really reflecting what's happening.
And I think, earlier when we were more optimistic, we talked about this sort of like industrial slowdown, ISM data being negative for a couple months, but hasn't affected the consumer at all. That still hasn't happened yet. We haven't seen major slowdown in consumer activity. We haven't seen a major turn in employment. But now, instead of assuming that's not going to happen, I'm almost waiting for it to eventually.
Yeah, I mean, I think
fall
everybody's looking for when the top of the stock market is.
Yep.
The conversation I had with some folks in finance is they think the election is going to be the precipitating event.
A lot of people were talking about the election.
And I think there's a lot of stress
Yeah.
going into the election, particularly if we have an embattled president and an embattled Republican Party going into the election, and there's concerns that far more liberal
I was
folks,
actually surprised about how many people, even like bankers on the M&A side, were talking about the election.
well, they're worried about it because if it changes, if it looks like it's going to go much further to the left,
Yeah.
then that could dry up capital flows. It could dry up private equity valuations. It could dry up venture capital spend.
Right.
So there's a lot of concern about it. I mean, I talked to a lot of VCs, and that's one thing that they're looking at is potentially next year being the top of the market for VC valuations.
Interesting.
And they think that the event that they've been waiting for 10 years, I had a conversation yesterday. The guy said, yeah, we've been looking for the top for 10 years, and we haven't found it yet, and it's still going. But maybe the election is the next thing. There could be a geopolitical event that happens,
Yeah.
but more likely if we don't have these black swan events, it very well likely could be the election that actually tips valuations over and then everything falls. I think if stock market starts to fall, that may dry up private equity valuations, and then VC will be the last thing touched, early stage VC,
Right.
because they're not valued on the same thesis as late stage companies,
Right.
but they will end up taking the blow as well.
Interesting. Yeah. Well, I think we still have to see the data come in the fourth quarter. Hopefully things are turn out better than they
So
look
good or
now.
bad, fourth quarter, you bullish or bearish?
Neither.
So I'm
Yeah.
neutral.
Yeah, same.
I mean, look, if I am
I would
more
say bearish. I
bearish
would
than
say
I
bearish,
was.
yeah.
If I'm more bearish than I was, I think certain parts of the freight market are going to do well, like the dedicated surge. I think the larger carriers are probably going to outperform the broader market, but certainly spot's going to be exposed.
Yeah.
It's interesting to watch. We'll see what happens. JP will be back next week. You're also going to be at FreightWaves Live. Have you registered yet?
I don't know.
Did we
Is
add?
that-
No,
did
did
you have to
register?
do that? Do I have
I
to
think you
register?
told me you registered. If you haven't,
Okay.
you better get your tickets.
Okay.
They are going to be on fire. I mean, there's a lot of people coming.
Yeah, no,
it's going to be the best party of the year as it relates to freight. November 12th and 13th in Chicago. If you haven't gotten tickets, get them today. You don't want to miss out. You don't want to experience FOMO, because if there's anything that's volatile, it is the market, and you want to know the impact of technology and where things are headed. So get your tickets, November 12th, 13th, Chicago. We will see you there.
Our industry is moving faster than ever. Where are freight volumes headed? How will this affect capacity? And of course, what's the newest technology that can benefit your business? Those questions and many more will be answered at the industry's hottest freight tech conference this November in Chicago. Come join us at FreightWaves Live, November 12th and 13th at the McCormick Center. Visit FreightWavesLive.com to register.